The capital gains tax is about to explode, and if you own assets or investments, this could hit you hard. In fact, recent reports suggest that taxes on your profits may increase by up to 50% or more in just a few months. That means thousands of dollars could vanish from your hard-earned gains overnight. This isn't just a warning. It's a wake-up call to protect your wealth before it's too late. If you want to understand how to shield yourself from these impending tax hikes and keep more of what you've worked so hard for, then this information is crucial for you. Make sure to like and subscribe now so you don't miss any vital updates. Now, let me show you why this is so urgent and what you need to know before getting started. The recent news is alarming. The capital gains tax rate is about to skyrocket, potentially reaching 50% or higher in just a few months. This change will dramatically impact anyone who profits from investments, eroding a significant portion of their gains overnight. If you've been relying on these investments to build your wealth, understanding this looming increase is crucial now more than ever. In the current U.S. economic climate, rising inflation, fluctuating markets, and government policies are creating a volatile environment. These factors make it essential to stay informed and proactive about protecting your assets. Whether you're a beginner investor just starting out or someone with some experience, this situation affects you directly. Today, you'll learn what this impending tax hike means for your investments, how it could reduce your returns, and what strategies you can implement to safeguard your wealth. By the end of this, you'll have a clearer picture of your options and be better prepared to make smarter financial decisions. But to make smart decisions, you first need to understand the economic landscape we're dealing with. Breaking news. The capital gains tax is about to skyrocket, and it's crucial for investors to understand what's happening in the broader economic landscape. According to the Federal Reserve, inflation in the U.S. has been rising steadily, hitting 3.7% in the latest data, the highest in over a year. This surge pushes prices higher across the board, including equities and real estate, prompting concerns about market stability and future policy moves. Interest rates are also on the rise. The Fed recently increased the benchmark rate by 0.75 percentage points, the largest hike in decades. Higher borrowing costs slow economic growth and can lead to market volatility. Meanwhile, the Bureau of Labor Statistics reports that wage growth is struggling to keep pace with inflation, squeezing consumers and reducing disposable income. In this environment, the government is considering significant tax reforms, including a potential increase in capital gains taxes, which could jump to 50% or more. This change aims to fund ongoing fiscal deficits, but poses a serious risk for investors holding appreciated assets. With the current market cycle showing signs of correction, especially in housing and stocks, the timing couldn't be worse. All these factors, rising inflation, higher interest rates, and impending tax hikes, converge to create a challenging environment for wealth preservation. Investors should be aware that these macroeconomic shifts can magnify the impact of tax increases, reducing net gains and complicating portfolio management. With that context in mind, let's break down the strategy you can actually apply. The main strategy to protect yourself from the upcoming surge in capital gains taxes is to understand and utilize tax-efficient investment planning. When you invest in assets like stocks or real estate, any profit you make is considered a capital gain. Right now, these gains could be taxed at a much higher rate, which means you might lose a significant portion of your profits to taxes. One key concept is timing. By carefully planning when to sell your assets, you can potentially minimize the taxes owed. For example, holding onto investments for longer than a year often qualifies you for lower long-term capital gains tax rates. Another idea is to invest in tax-advantaged accounts like retirement plans, where taxes are deferred or reduced. Additionally, diversifying your investments and spreading your assets across different types of accounts can help manage your overall tax burden. Some investors also consider giving assets to family members or charities, which can provide tax benefits and reduce taxable gains. It's also important to understand the difference between realized and unrealized gains. Realized gains happen when you sell an asset, triggering a tax event. Unrealized gains are increases in value that haven't been sold yet. Managing when to realize those gains is crucial in planning your taxes. By learning these basic principles, you could develop a strategy to keep more of your profits, even as taxes on gains are set to increase. Now, let's look at a real-world example to see exactly how this plays out in practice. Imagine you bought a property 3 years ago for $200,000. Over time, the market appreciated, and now it's worth around $350,000, according to Zillow. You decide to sell, and after deducting selling costs of about $10,000, your net profit is approximately $140,000. Under current rules, if you've held the property for over a year, this gain is considered long-term capital gain. Without any tax planning, you might face a tax rate of around 20%, which will mean paying roughly $28,000 in taxes on your profit. That's a significant chunk of your gains potentially lost to taxes, especially if tax rates increase as proposed. Now, let's think about potential strategies. If you rolled over some of your gains into a 1031 exchange or use a retirement account, you could defer or reduce those taxes. Alternatively, holding onto the property longer or offsetting gains with losses could help minimize your tax liability. This looks great, but only if you avoid the common traps that ruin deals like this. Breaking news: capital gains tax is about to explode, and without proper planning, your hard-earned profits could be significantly compromised. But don't worry, by understanding common mistakes and how to avoid them, you can protect your investments and maximize your returns. First, many investors make the mistake of neglecting to plan their sales in advance. They sell assets impulsively without considering the tax implications, which can lead to unexpectedly high bills. For example, imagine someone who sold a property after a quick appreciation, only to find out that nearly 20% of their gains went straight to taxes, money they could have preserved with strategic planning. Second, overpaying on taxes often happens when investors overlook available strategies, such as 1031 exchanges or tax-advantaged accounts. Skipping these options means leaving money on the table and reducing overall profitability. Think of it like missing a coupon that could save you hundreds at checkout. Third, many fail to diversify or time their asset sales carefully. Selling everything at once or in a high-income year can push you into a higher tax bracket, increasing the tax burden. Picture a scenario where an investor sells multiple assets in a single year, unintentionally inflating their taxable gains and losing more to taxes than necessary. Finally, ignoring the importance of loss harvesting, selling underperforming assets to offset gains, is a common oversight. This tactic can significantly reduce taxable gains, but many overlook it. To avoid those mistakes, here are the best tools and resources available right now. Breaking news: capital gains tax is about to skyrocket, potentially reaching 50% or more. If you're an investor, now is the time to act and protect your profits. Luckily, there are powerful tools and strategies to help you navigate this challenging landscape. First, consider using TurboTax or H&R Block. These tax preparation platforms can help you understand your current tax situation and plan ways to minimize liabilities through strategies like tax loss harvesting or retirement contributions. Both platforms offer step-by-step guidance tailored to your investments and income. Next, explore Personal Capital or Mint. These financial management apps provide a comprehensive view of your entire portfolio, helping you identify underperforming assets and opportunities for tax loss harvesting, selling assets at a loss to offset gains. This can significantly reduce your tax bill. Third, leverage Charles Schwab or Fidelity for investment accounts with built-in tax-efficient features. They support tax-advantaged accounts like IRAs and 401(k)s, which can shelter gains from taxes and offer tools for strategic asset rebalancing. Finally, check out Investopedia for educational resources on tax strategies and investment planning. Their articles break down complex concepts into easy-to-understand advice, empowering you to make informed decisions. Now that you've got the tools, let's talk about the first thing you can do today to get started. Review your recent trades and identify assets with unrealized losses. Selling these can help offset gains, reducing your tax burden and keeping more of your money in your pocket. Breaking news: the capital gains tax is about to explode, and your investments could be hit hard. But here's the good news. You don't have to feel overwhelmed. The first step is simple, realistic, and powerful. Today, take 5 minutes to review your recent transactions and identify any unrealized losses. Why does this matter? Because recognizing assets that are underperforming now allows you to plan smarter, potentially selling those investments to offset future gains and reduce your tax burden. It's a small move that opens the door to bigger gains later. Plus, by taking this step today, you're building momentum, showing yourself that proactive planning is within reach. Imagine the confidence you'll feel knowing you're one step ahead, turning a moment of uncertainty into an opportunity to protect your hard-earned money. This initial action is just the beginning, paving the way for more strategic decisions, like exploring tax-advantage accounts or setting up a long-term investment plan. Taking that first step is how every long-term success story begins. Let's look forward. With consistency and small, focused actions, you can navigate these changes confidently, building a stronger, more secure financial future. Remember, progress starts with one small move. What will yours be today? Imagine yourself 10, 15, or even 30 years from now, looking back at the investments you've made today. With capital gains taxes on the rise, the key is to think long-term and stay consistent. Consider starting now by reviewing your recent trades and identifying opportunities to sell underperforming assets, reducing your tax burden while reinvesting smarter. Small, deliberate steps today can compound into significant wealth tomorrow. Picture owning 5 rental properties by 2035, each generating steady cash flow, appreciating in value, and building your financial foundation. Or imagine growing a diversified portfolio that doubles in value every decade, thanks to disciplined investing and tax-efficient strategies. These aren't just dreams. They're achievable outcomes when you prioritize consistency and strategic planning over time. Remember, the power of compound growth isn't just about the numbers. It's about your future freedom and security. Every decision you make today sets the stage for a more stable tomorrow. And now that you see what's possible, here's how we wrap this up and take action. Start by dedicating a few minutes each week to review your investments, explore tax-efficient account options, and educate yourself about long-term strategies. Small, consistent steps today will build a stronger, more resilient financial future. The best time to act is now, because the habits you create today will define your success tomorrow. Breaking news. Capital gains tax is about to explode, and now more than ever, it's crucial to adapt your financial strategy. The key takeaway? Long-term planning and smart investments are your best defense against rising taxes. By reviewing your holdings regularly, harvesting losses, and reinvesting wisely, you can minimize the impact and keep your wealth growing. Remember, small, consistent actions today lead to significant growth tomorrow. Whether that's diversifying your portfolio, exploring tax-advantage accounts, or staying informed about policy changes. Thanks for tuning in and celebrating your progress on this journey to financial security. Every step you take brings you closer to your goals. Stay disciplined, keep learning, and don't forget, your financial future is in your hands. If you found this helpful, hit that like button, subscribe for more updates, and leave a comment below. What's your first financial goal for this year? Want to go deeper? Check out our related video on top strategies to reduce tax liability and keep building that wealth. Remember, staying proactive and educated is your best tool in navigating these changing times. Stay confident, stay strategic, and I'll see you in the next video.